was going to say, I love that framing because it does really summarize this notion that our view of a risk parity portfolio is the neutral starting point. It is the neutral stance. And anybody that thinks of their 60-40 as the natural beta is not a student of history, is somewhat affected by recency bias, but is making a very active bet on a particular regime. And that you might call that their pursuit of alpha. It's not beta so much because you're making a very active bet. So I wanted us to maybe from that starting point, talk a little bit about how we've been talking about pro-cyclical versus counter-cyclical risk parity. Then you start getting into implementation and tactical tilts. And so how do we think about that implementation in terms of preserving
let's start at the basics, right?
Of beta?
Let's start at the basics. So maybe Adam, what are the basics of risk parity? What's the basal assumption in the portfolio construction? Like where we start there, and then let's move from there. Yeah,
that's a good question, right? So a good way to think about risk parity is that it's the mean variance optimal portfolio. In other words, it's the most efficient portfolio that you can construct. If you believe that markets are risk efficient, so that you believe that big diversified asset classes like global equities, global bonds, global commodities are priced appropriately for their level of risk. And if that's true, just sort of inverting that, it means that all of these big global asset classes are expected to produce the same return per unit of risk. In other words, the same excess return above cash per unit of risk, the same expected Sharpe ratio. So if all three of these big major buckets are expected to deliver the same broad Sharpe ratio, then a global risk parity portfolio along the lines of how we described its construction is mean variance optimal, which means it is the most efficient portfolio that you could create, right? So it's simply saying an asset's return, excess return is proportional to its risk. So markets are risk efficient, okay? Now, I love that we came here because I was really hoping we were going to have a chance to talk about the different methods of construction for a risk parity portfolio and sort of setting aside for a second the way that Bridgewater has chosen to do it based on kind of economic fundamentals. We approach it more from a quantitative standpoint. And I think a lot of practitioners and a lot of quants attack this from a systematic standpoint, a quantitative standpoint. And what do they do? They take all these different global markets and they say, well, I'm going to try this risk parity implementation, and I'm going to then back test this implementation going back, as far as I have data. And then I'm going to test this implementation going back as far as I have data, et cetera, right? And then they'll look at the results and say, well, I will choose to run the implementation that had the highest Sharpe ratio over my test horizon. That has a lot of flaws. One big one is that typically the historical test horizon consists primarily of a single type of regime. So I'll give you an example. We wrote a paper called Risk Parity Measures and Methods and Measures of Success. We tested a variety of different risk parity implementations. Some of them they kind of weighted the markets in the portfolio based on the inverse of their variance. Others weighted them on the inverse of their volatility. There's a bunch of different cuts at this. But if those that weighted on the inverse of variance, by the way, the hierarchical risk parity method that DePrado suggested weights these broad asset classes and markets on inverse of variance, okay? That gives much larger weight to low vol assets, which means that it gives historically, it will have given a much larger weight to global bond markets. Now from 1980 to today, global bonds, well, maybe not to today, but until 6 or 18 months ago, global bonds had a much higher Sharpe ratio than either equities or commodities over that sample horizon. And therefore, implementations that by construction will emphasize bonds or have a higher weighting in bonds are going to look a lot better. They're going to produce a higher historical Sharpe ratio than other methods. But we need to recognize that those methods are not well balanced. They do have a much higher exposure to rates, and so are especially vulnerable to an environment like, for example, the recent environment that has been very unkind to rates, right? So it's important to construct a risk parity portfolio not from the perspective of what delivered the best backtest, but rather what design methodology makes you maximally resilient to all of the major economic risks, the growth and inflation risks that you may face in an ambiguous and uncertain future.